I'm Keith McCullough, and welcome back. That was an excellent conversation, as it always is, with Danielle DiMartino Booth. Can you imagine saying that about Landman? That was quite a thing. I get to go back to back with Danielle DiMartino Booth and Bianco. Now, not many people get to do that. Some people are watching the Masters right now, Bianco. Some people are watching us because the S&P's down 4%. Okay, so for better or worse, you and I have, I don't know, we definitely have over 100, we have almost 100 years experience doing this damn job. I mean, this is a sight to see, having a 9.5% SPY update to what we have today.
Oh, are we having fun yet? Yeah, exactly. Yesterday looked like a hole-in-one, and today we're off in the rough, to use a Masters analogy, right?
Oh boy, which isn't like, I mean, I'm sure you did too. I mean, anybody who's been in the game for as long as we have remembers 2008. I mean, that was the biggest up day since 2008, and those were the two biggest up days for the U.S. stock market ever. What is it about, that moment that gets people to come back in on days like that?
Well, I think what happened yesterday, I mean, first of all, I would say one of the things that might be also happening with this market is that we also have the experience of 5 years ago. So, my bailiwick is the bond market. And I've been saying to people, boy, what I saw in the bond market yesterday, if it wasn't for COVID, I would have said was completely unprecedented. But we saw something similar to that 5 years ago. But that's it. Those are the only two times in history we've seen it. But it's to your question about what gets people back in the market is, first of all, if you saw the speed of the rally yesterday, that's not human beings making a decision. That's a lot of computers, and that's a lot of hedge fund wise guys trying to front run the market. Remember how a speculator works. If I'm a speculator, you're a speculator, we have our computers. We buy the hell out of the market and we push it up and push it up and push it up. And we hope that we create an uptrend that regular people and regular managers that make human decisions say, wow, look at that uptrend, we got to get on it. Yeah. And then we sell to them and walk away to profit. What today was, we pushed it up, we pushed it up, and we pushed it up, and we looked around and said, there's nobody here. And then we all said, time to leave. And that's what we're seeing right now in the market. Get out, get out, get out. And so that's what it basically, if I think happened, was yesterday was a lot of speculative buying, a short cover, a lot of algo buying, and they were hoping that the news today, not that they were thinking this way, the news today would get everybody to say, uptrend, rebound, 50% retracement, got to buy. And no one showed up is basically what happened.
And they didn't show up in the things that they already own, right? That's a big part of this, is I call it the bag seven now, but the, you can show the Verdad chart that we've been showing, Rasmussen's chart, guys, just, and Bianco knows this, but 30% of what the quote unquote market is 7 stocks, and it's closer to 45% of the volatility. So, when yesterday 30% of the S&P's update came from 3 stocks, NVIDIA, Apple, and Microsoft, like, all you need to know is that those stocks are going down today. I mean, how do you get out of this? I don't think you've minced any words on this. I don't think that you didn't call this a bubble. I mean, when a bubble's coming unraveled, I mean, where does it stop? People keep asking me. I'm like, not yet.
Well, I think if you were to back up to February 19th, which was the all-time high, which, by the way, in 2020, it was also February 19th, which was the all-time high.
Crazy.
Coincidence. But if you were to back up to February 19th, what would have been the argument for buying stocks at the all-time high, given the valuations? AI, new era, president that's business-friendly, don't worry about valuation. Wait till you see all the earnings that everybody's going to make. Well, what's happening now in April is where's those earnings? And what confidence do you have that we're going to see this big spurt of economic profitability coming forward? That's what's got this market down. Look, I've been arguing the way that you wind up deflating a bubble is after a break and a rebound is you have a long period of sideways action. Think about 2000. By 2013, we had a bubble peak in 2000. 2013, we were at the same levels. We went sideways for 13 years, but companies kept making money. So earnings outpaced the stock market. PE ratios and valuations came down to a reasonable level. And then from 13 to 2020, we then had another big move. So I think we're in a period after this volatility, which might last several months or maybe a year. We're going to be in a period of chop, sideways market. But like that period from 2000 to 2013, it won't be, do I buy SPY or do I sell SPY? Because that might be going sideways. But there'll be sectors,
Yeah.
there'll be themes, there'll be stocks that you could play. Like, I've often said to people, if you go back and look at the 70s, you might say, the 70s, wasn't that a horrible time to own stocks? Yes, to own the index, although we didn't have index funds. But if you played energy right, if you played industrials right, if you played consumer cyclicals right, man, you made all kind of money during that period because you had the Nifty 50, then you had the energy boom, you had stuff going on. Just it was always being offset by something else in the index, and that's what I think we're going to start to see here. Maybe it's not going to be an index rally, but there'll be stuff to do, and it'll be a little bit different. I think the problem, Keith, maybe you can answer this better than me, is we've got everybody so locked into buy SPY, sell SPY, buy SPY, sell SPY. Yeah. And now we got to tell them, no, there's, SPY's 500 stocks. It's not an individual thing to itself. And those 500 stocks have themes and their individual stocks and stuff. Oh, okay, I could do that. Well, you've never done it before. It's going to be really hard to make that transition for a lot of people.
Yeah, I mean, trying to get people to buy the GDX or the gold mining stocks that are in the S&P 500, I mean, people are like, they don't even want to entertain it. And that's probably why gold miners like GDX is hitting a new high today. I mean, that's actually the lesson. If you go back to all the lessons, you and I have made more mistakes than anybody just by definition because we're out there all the time and we've been out there for a long time. But, that's the whole point, is it not? Is that coming out of 1999, you had these concentration factors to growth and to all the fun stuff. The bleeding out of that, there was a bull market that started in gold, by the way, in 2002. The REIT sector started as a big component of the S&P 500 coming out of 2001. You had, Nike, anything that was consumer facing, ended up going in a bull market early, starting in 02, 03. We got to get there, though. You got to, this isn't like, I guess, well, I don't know. I mean, I don't know what it is. I mean, I'm going to ask you, that sector rotation needs things, right? Like to get energy stocks, you need the oil not collapsing. You need oil to stop going down.
Right.
So pick what is it going to be? I mean, what are the things that you would expect to see lead us into the next bull market?
Well, right now, the problem is that we don't know what it's going to look like. I mean,
right.
We're tariffs on, tariffs off. I mean, could we actually make an entire 24-hour period without epically changing the tariff outlook in this market right now? As I said, the one thing that's changing faster than market prices is the tariff on China. I mean, we're going to need a ticker symbol on Bloomberg to watch that go up and down too. And so once we start to get a feel for that, but right now, I think the big themes that are definitely working is, you mentioned gold. Gold is one that is working, and you're right. Gold has got two problems with it. One, you mentioned gold to people, go, well, you never make any money on gold. I was like, have you looked in the last year what gold has been doing? And two, if you talk to the younger crowd, it's like, but we own digital gold called Bitcoin. Have you looked at what it's been doing over the last 6 months? It isn't digital gold anymore, and the like. And then the second thing is, there is some resistance to some of these types of themes. What has worked this year, until literally 2 days ago, was Europe. The rotation back into Europe, because they're going to try and stimulate their economy. That one got a lot of pushback as well, too. So it's all part of this whole thing where everybody's such an index buyer, you get a real difficult time. I've used the analogy. I think what we're suffering from is the 20% gains in 23 and 24. And I've used the analogy of a sailing. I don't know nothing about sailing, but I do know if you put me in a sailboat with a 25 knot wind, 25% return in the index, all I got to do is get that sail up in the air and my boat's moving forward. But if you put me in the boat and it's a 5 knot wind, a 5% return in the market, well, now I need some skill. I could tack and I could trim and I could get that boat to move forward. That's the environment we're in. You're going to have to learn how to tack and trim, and not just get the sail in the air. Don't worry, that big gust of wind will push you forward. Mm-hmm. And so to that thinking, you got to start thinking, maybe Europe is a place to be. Maybe it's not now. Maybe gold miners are a place to be. When does oil bottom? How do I play the energy stocks? What about
Yeah.
the healthcare stocks? What about financials? You got to start thinking in those terms. And a lot of people have not been thinking that way because, frankly, they haven't had to. I've got a lot of manager clients like you do. And one of the themes I've heard from them is, look, I pick stocks, I pick themes, and I've got these ideas, and I think they work well, but the index goes up 25%. No one gives a shit because the index is up 25%.
Yeah.
Well, maybe if the index is going to be up 5%, they'll now start to care.
Yeah. Or the index is going to be down 10 to 20%, and they're really going to start to care because gold's up in the last 3 months. Gold's up 15, 16% alone. I mean, that's an absolute number. I mean, the relative return is epic. Well, this brings us to your bailiwick, like to the bond market. I mean, the bond market, to me, you'd think that I wasn't making money in the bond market, by the way, looking at the commentary out there about like yesterday's headline. I couldn't make it up if I tried, inclusive of today's, by the way, which is after yesterday. Bloomberg's #1 headline this morning was billionaires score their best day ever. I don't know who the hell signed off on that, but that's what they went with today. Billionaires had a great day. Well, I guess they're going to have a terrible day today. But the day before that, the headline, #1 headline on Bloomberg, was bond markets crater amid dash for cash. Okay, I use these as contrarian signals. They're not always perfect, but that one was pretty damn close. I mean, first of all, if you're dashing for cash, last I checked, you'd buy the dollar, and I'm short it, and it's completely collapsing today. Second of all, if you're, and I'm talking about the Treasury bond market. The short end of the curve is getting me paid again today. A steepener is getting me paid again today. I mean, it's like, okay, I can watch Wall Street panic about bonds, or I can just be along the right part of the curve and just go on with my day.
That headline doesn't make any. I didn't see that headline. Thanks for bringing it up. It doesn't make any sense because in our financial system, Treasury bills and short-term bonds are considered cash. They are cash. So I'm selling cash to buy cash. I'm selling the 2-year note to buy a 1-year bill, and that's somehow dumping. So this is the problem: is that if you're dumping bonds, that is not a dash for cash. That is cash. So. I understand. They could say shortened duration, but they didn't say that. And stuff. So I don't quite understand what they were trying to say there. But I think that, though, you're right. There is a bigger issue, and that is the bond market finally, reared its head. The old bond market vigilantes, or the famous Jim Carville line: "When I get reincarnated, I don't want to be a 400 hitter or the president. I want to come back as the bond market because you can intimidate everybody." And I've been using that line for the last few months and been saying something to the line of, I know that the administration has been saying that, the S&P is not our measure of success. It's the 10-year yield. And I've been warning, be very careful about that. Jay Powell doesn't control the 10-year. Trump doesn't control the 10-year. Bessent doesn't control the 10-year. Wall Street doesn't control the 10-year. It's an animal unto itself. It will do whatever it wants to do, regardless of what you think it should do or how much you want to try and manipulate it. And what we've seen is the yields have been going up. And now I think the reason the yields are going up is we're going to get inflation. We're going to get tariff-driven inflation. And prices are going higher. And I know Wall Street economists like to say, yeah, but that's a one-time step up and, inflation comes up because of tariffs, and then it's done going up. Market's not so sure about that. Market is saying, look, we're going to get inflation. We're going to get inflation. And if we're going to get inflation, I don't want to own bonds at these yields if prices are going higher. And that's why we're seeing selling.
You know what's interesting about that? I mean, first of all, there's it's right on the screws, like what I call duration mismatch. And I'm not talking about bond duration. I'm talking about duration of your theory or whatever your view is on inflation, which is a really important one. I mean, today, first of all, inflation went down. I mean, it went down to 2.4%. But in our nowcast, at least, Jim, you guys can show our inflation nowcast. We have it hooking up in the back half of the year. So it makes like a higher low around like 2.2, 2.3, and then starts to take off again. The bond market's very good, the long end of the curve, to your point, at front running that by, it used to be 3 to 6 months. Now it's kind of 1 to 3 months. But
right.
But if that's right, like if we're right, and we've had a very good run here on getting the direction of inflation right, which is important because it keeps flipping around. But if that's the case, It wouldn't be much. Wall Street's so narrative driven. They don't have a macro process, but they have narratives. And that at least half the country who hates Trump is going to be saying the tariffs are inflationary once the inflation numbers start going up again.
Yeah, no, you're right. I'll assume that your inflation nowcast did not include anything with tariffs. And,
no.
Yes. So yeah. I'll give you an interesting stat I heard this morning.
That's the inflation nowcast based on the inflation slowdown. Again, don't forget that inflation. You wouldn't forget this, but inflation, guys, show the inflation nowcaster on the shorter term. I mean, on our actual nowcast. I think it's on slide 27. That reflects the base effects collapsing when inflation went from the left side of that chart 3.3% down to 2.4 last year. So again, base effects ease, inflation go up. So again, that's pre-tariff impact, whatever that's going to be, and to your point, like August, September in particular.
Right, and something to keep interesting about tariffs. Torsten Slok was on Bloomberg. He's the chief economist at Apollo. Gave an interesting statistic: 71% of all sellers on Amazon source their products from China, and now they got to pay 125% more for those products. Now they've got some inventory they can run down right now, but what happens in a couple of weeks to a few months when they've got no more inventory? Do they close up shop?
Yeah.
Or do they just start paying higher prices? And that all of a sudden you're going to go to Amazon and you go, whoa, where did those prices come from?
Yeah.
Those are going to be tariffs. And that will filter through into things like Trueflation and the CPI and everything else. So you're right, the bond market is not looking at today's CPI numbers. In fact, I heard it dismissed as, well, that's the last non-tariff CPI number. In other words, it's looking forward. And I'm with you. I think looking forward before tariffs, we were also of the opinion inflation was probably finding a low here and it was going to start to drift higher. Now you're going to add an artificial constraint on prices, especially the prices that matter to us. And that's the cheap stuff from China is not going to be so much, it's not going to be cheap anymore. Those prices are going to go up. And that gets me to the bond market.
Yeah.
There's when you're a central banker, you've got one of two options. You can either want to be Arthur Burns or you could be Paul Volcker. Arthur Burns saw prices going up. He worried about growth. He cut rates. And he is now generally considered to be the worst central banker who's ever lived. He was the central banker of the Fed in the 70s. In the early 80s came Paul Volcker. He raised rates, held the line even though the economy was going into recession, broke the back of inflation, and he went to central banker heaven. I don't know where Arthur Burns is, but he's not in central banker heaven right now. So if you've got and Powell hinted at this last week, if you've got a weak economy and maybe even a recession because of tariffs and uncertainty and all that other stuff, and you got sticky inflation and higher inflation coming because of tariffs, weak economy, inflation being a problem, you don't cut rates.
Yeah,
you don't cut rates.
That's
and that's really the issue that I think came to if you would ask me what happened in the bond market this week, is I think that a lot of levered basis traders and a lot of people that were playing the bond market said, we're long bonds because the shit's going to hit the fan. I'm going to use some technical language here for you. And the Fed's going to cut rates. And then they started to realize the shit is going to hit the fan and they're not going to cut rates. We got the wrong position on. And I think that that's what you saw happen in the bond market this week, is that they started to realize, I was arguing this on Twitter 2 days ago or 3 days ago. It's like, stock market's down 20%. Goldman says recession. JP Morgan says recession. Larry Summers says recession. Why are the odds that the Fed is going to cut rates 58% in a month? It should be 95% today that they cut rates. And the answer is something is holding everything back. And that something is this latent fear that we have not solved the inflation problem. And if we cut rates aggressively, we wind up stoking more inflation and we wind up becoming Arthur Burns. Mm-hmm. So they're thinking more like they're going to become Paul Volcker. Right?
Yeah, I think it's, well, first of all, that is the history of the 1970s. For people that don't remember, that was a decade of what we call quad 3 stagflation. So that's when your dollar's going down, real world cost of living's going up, and it's sticking no matter what the Fed does, right? So that, okay, But then you have the labor market, right? Like Danielle would turn around or just did actually. She just said, okay, and we weren't talking about my inflation nowcast. It's another part of the stool, right, Jim? We have the three parts of the stool, at least according to me. One, some people disagree with. Obviously inflation. Where's inflation? One, two, where's the labor market? And three, where are capital markets? But she said, look, the labor data is going to be so bad ahead of the next Fed meeting that's going to be where he starts to pivot towards is not talking about inflation and talking about the people and the risk of losing their jobs.
She could very well be right about the inflation data, but this is the fundamental question for the Fed and for Wall Street is if you give me a set of weak real data, jobs, sales, and the like,
yep,
and you give me a set of sticky inflation with higher prices coming within tariffs, which one matters more?
Yeah.
And I would argue pre-2020, it was the growth data that mattered. It was only the growth data that mattered. But post-2020, post saying inflation was transitory before it went to 9% and the like, they are very worried that this inflation thing is going to get behind them. And then throw in there that a lot of the surveys of inflation, I know the Michigan survey, they ask people, what do you think your inflation outlook is going to be over the next year? And the like, those are going up. Now, that some of them are skyrocketing like Michigan, but others are kind of creeping higher. That is really how much does the inflation data matter? And what Powell told us is it's the majority of it's 55% inflation, 45% growth. So if you've got both at the same time, we're going to hold.
Yeah.
Is basically what they're going to do. And that's what the market is pricing in. The market is pricing in a hold. Like I said, given what we've been seeing, if this was 2019 and Trump did this with tariffs in 20, they'd be cutting every day.
Yeah.
But the reason they're not is because of inflation.
It's interesting that the inflation surveys, in particular, the politicization of those things, and that it circles my point, which is if and when inflation starts to go up in the back half of the year, half the country is going to call it Trump's fault. Tariffs equal inflation. You can already see it. Guys, show slide 49 where we show if you ask Republicans 1 year inflation expectations versus Democrats, you get the opposite answer. It's like, have you looked at this? I mean, this is ridiculous.
Oh, yeah. And if you go back to 2020, you got, it was the reverse of that. And unfortunately, what's happening with the consumer confidence data, all the consumer confidence data is highly partisan. Now it's become like a political poll. Because the next question you have to ask yourself is, okay, what percentage of your poll is Republican and what percentage of your poll is Democrat? And is that representative of the country? Which is what we ask with every, what we ask with every approval rating or who's leading in the election, whether Harris or Trump had a lead or not a lead. The first thing you do is you go, what percentage of them were Democrats or Republicans in the poll? This is what we're going to have to now do this with economic data.
Yeah.
Is what's happening.
Well, that's the political piece, right? That's the short-term answer. And I think that this is where, if I had you and Danielle, I could at least be the referee and say, you guys are talking about two different durations, right? And I am too. I had the street low nowcast for CPI today and pinned the tail on the donkey. That's where it landed. And we have one more low one, which is next month, and then we have it going back up. So if you ask a Republican, what inflation numbers just did today, they say they go down. And if you ask a Democrat, they're like, well, it's going to be inflationary, so it's going to go back up. Your point, I think, is on a much longer duration. Guys, go to slide 50, which is if you ask the University of Michigan survey, if you ask on a 5 to 10 year basis, like this is there are regime shifts and then there's charts like this, right? Like in our career, you've never seen step functions like this. So you're not taking it all out and going back to what, like 2014, 2015, 2016 was really low in terms of the aggregate inflation expectations over the long term. Is that fair where the longer term picture is easier to call than the very short term?
Well, it can be because, there's a lot of noise. But to get back to that phrase you use, step function, the longer term can be easier to call unless you're in the middle of a step function. And then all of a sudden the whole longer term picture starts to change. And that's really where we're at right now. But those numbers from the Michigan survey are out of control, because even though we didn't have the Michigan survey in the 70s, people are now, that chart you just had up, they're now expecting more inflation than we had for the average of the decade of the 70s. It's like,
those are crazy.
I know. I didn't realize we were going to repeat the 70s, because that's what people are expecting right now, is some kind of a repeat of the 70s.
Well, I think that, and by the way, on the inflation pull forward, right? So people are so, bass-ackwards on markets right now, in particular the bond market, the currency market. A lot of people that own stocks don't even know what those two things are, but therefore they are bass-ackwards on the whole thing. But if you say, okay, look, I'm going to pause for 90 days, well, now you pull forward even more. So, like, the guys, show the pull forward chart on slide 52, where you're seeing this pull forward of U.S. consumer goods in particular, like to Jim's point. Like, okay, like my wife's 50th birthday, which she wouldn't want me to disclose, like I just bought a bunch of stuff for this party that we're going to host for her. It costed me, Jim, on Amazon, back to your point on what'd you say, 70% of things from Amazon?
71% are sourced from China.
Well, I'd say 100% of what I bought, because I'm a cheap fuck. I mean, I spent $88 on her birthday party. I mean, $88. I got balloons, I got hats, I got necklaces, I got all sorts of stuff. And it's really nice stuff. But I bet you, if that's made in America, that costs $1,000.
Oh, I agree. And so if you go back to that chart, this is what's going to also be interesting too, is that the Atlanta Fed GDP now is now saying that the first quarter numbers are going to be something like -1% if you take out the gold imports.
Right.
And so, but let's understand how we got to -1%, because if you look at the way that they break it down, and for those that don't understand, Atlanta Fed GDP is what's called a tracker data. They take all the data that's come out and they say this data is giving us a run rate on GDP of a certain level. I've likened it to, I take your split at the 10-mile mark and I say, well, if you keep running the same pace, this is going to be your finishing time in the marathon. Now you might speed up, you might, that's not bad. I mean, It's a good metric, but you might speed up, you might slow down. But what's driving it down right now is net exports are becoming really negative. In other words, we have been importing a tremendous amount of stuff pre-February, pre-March, ahead of tariffs. And so everything's been coming in. And there's a story today in the paper that after the Liberation announcement, that Apple chartered 6 cargo planes to bring 1 million iPhones into the country before April 9th from India, so that they could get them in before the tariffs on iPhones. So they just had them land yesterday, like 6 planes with 1 million iPhones on them. I hope they were all in airplane mode. And so, so that's the type of thing that you see. And you know what that shows up as in GDP is a negative.
Yeah.
Because the GDP to make that iPhone was done in India. And so they get the GDP. When we import it, it's a subtraction to our numbers.
Right.
Now, what could very well happen going forward is everybody stops importing stuff. I don't know what to do. It's too expensive. The import numbers plummet. The net export number goes up. And people said, man, where do you see the second quarter GDP? I said, be careful. It might be 6%. Only because we stop importing stuff.
Yeah, it's exactly that's exactly how I back people off on why I'm long one of the many reasons why I'm long a steepener in the yield curve is that my second quarter GDP number is mathematically impossible to be down if the Q1 number pikes like the way that it's piking, because it's a sequential reality. And I get the tariff shift in terms of time shift and behavioral shift in between. The gold piece alone that you just hit on. I mean, most people, thank God I got Bianco, because he actually knows what he's talking about. I mean, slide 54, we're showing here, look at this chart, man. I mean, this is showing you U.S. gold bar imports.
Yes.
That alone, what was that, like a third of it? That, and just so people know what we're looking at here, again, this is just front-running tariffs, right? So you're
right. Those red bars on the left are just front-running tariffs. That's what that is.
Exactly. Yeah. So I'm going to buy as much gold. I'm going to import as much gold from my homeland, from Canada, as possible until Trump puts a fucking tariff on it. Like,
right.
It's not the behavioral concept is really easy for people to understand. Taking it and imputing it or superimposing it into GDP expectations, absolutely not.
Right. And like we were saying, if you look at those red bars and you look at the orange line for gold, that's front-running tariffs. So what should happen next? Those red bars should just completely reverse because everybody stops importing. The gold import number should just drop to zero is what it should do next. We've already done it. We don't need to do it again a second time. And then that will, as you said, GDP accounting never been clear as mud. When that happens, it sends GDP through the roof. That doesn't mean the economy's better. It just means understand the way the statistic is being calculated. And, so if you're waiting for confirmation from these statistics, they're going to give you kind of screwy readings here.
Well, I think, so I and Danielle would say that Danielle said it just, in the prior conversation. The Q1 GDP number, unless you're living under a rock and don't know how to model this at all, which, by the way, a lot of people don't. In fact, most retail investors, that's an insult. They have no process. If you get called that.
The Fed doesn't either, but go ahead.
but you and I and Danielle know damn well that the Q1 GDP number is going to be weak, and it's also going to be stated right before the Fed May meeting. So you have all you need in between that is a weak jobs print, and you're going to have plenty of dovish data, including down markets, which is another part of the thing, to start at least with rate cuts. But then once you get to the other side in Q2, and inflation starts to go up again in Q3, and the GDP number for Q2, which is stated in Q3, go back up, you lose all those cards. So
right.
I think, if you disagree with me, you'd be the first one to disagree with all that. But that's a pretty important playbook to play out on both sides.
Yeah, no, it is. It is definitely really important to understand how these numbers are going to play out and what is the new reaction function going to be in the market. Let me give you a couple of things about reaction functions. Just bring it back to that everything's about this inflation part of this equation, and that this GDP number will just feed into that equation for inflation. In 2022, we had the Fed raising rates 75 basis points a meeting. We got 9% inflation. The highest that the 10-year yield got full stop for the entire year was 4.22%. Right now, it's 4.34%. It's higher now than it was when the Fed was jacking rates 75 a meeting and we had 9% inflation. Why is it higher now than then? Because when the Fed was jacking in rates and trying to fight inflation, the bond market was cool. Okay, fine. You're going to help hold down the inflation rate, even though it's really high. I'm comfortable owning bonds. So July of 23, it was at 380, the 10-year note. The Fed raised rates for the last time and said, this is the last time. What happened? Bam, straight to 5%. Why? Well, if you're not going to fight inflation, I don't want to own your bonds. And that happened in September. We were at 360 in September on the 10-year note. Fed cuts rates 50 basis points. If you don't give a shit about inflation, I don't give a shit about your bonds. They went up 100 basis points in the next 90 days.
Yeah,
is what they wind up doing. So the action has been clear in the bond market. It cares about inflation. It cares about inflation. This is not 2019 anymore. So you get back to those numbers again with the trade deficit and everything else. If this market cares about inflation and the Fed needs to be vigilant about inflation, and you get a rebound in that data, and you're talking about a cut, I think the bond market would be taking it poorly. I actually would argue, I know this is I'm being a heretic here. You want to bring down the 10-year note? Raise rates. Raise rates and bring down the 10-year note. But they're not going to do that. So they're going to do the next best thing, which means that in the midst of all this weakness, they're not going to cut rates.
Well, to your point, when they're cutting rates, bond yields went up. So, a Fed hike could easily cut rates. It's not. And that's the whole point, is that the Fed, to your point, You snuck that in there, but you're very consistent historically. People know that that's not a sneaky move by you. I mean, you're being critical of the Fed. I mean, and their ability to forecast their way out of a paper bag. I mean, they've been dead wrong at every single wiggle and turn in the sine curve of inflation going back the last 2 years, and then obviously on the big one on the way up that was not transitory. So, we do have a chart here that I think you're going to like. You can use this if you want, if you don't already have it on your own. Slide 55, guys, on the Fed. Because it is hilarious to watch everybody kind of like huddle like rats around the Atlanta Fed GDP now number. And the real reason for that is because everyone at the Fed knows they can't model it. But check out these inflation-adjusted compensation numbers, Jim, of the Fed board, the Fed banks, versus private sector employees and God forbid, federal agencies. I mean, since 2008, inflation-adjusted compensation at the Fed is up 67%, and their accuracy has hit an all-time low in forecasting.
Don't send this chart to me. Send it to Elon. Doge needs to get on the case here with this, right?
How is Elon not on that? Look at the hockey sticking of the number of employees. The last chart, you see the 67% compensation, but 24,553. When you and I started this job, this was less than 20,000.
Right, and you want to know what most of them do? What do most of these people do at the Fed? I mean, there's only 19 members of the Fed board. There's a couple hundred economists. What do the other 24,000 people at the Fed do? Well, some of them are involved because the Fed is also a regulator of banks.
Yeah.
So some of them are involved in bank regulation, and they did a bang-up job during Silicon Valley on that one. And then, the vast majority of the Fed employees are involved in check clearing. And checks, do we still write checks anymore? Well, they got tens of thousands of people that are involved in check clearing. And the check clearing process, we've heard from Doge about that example that when you want to retire from the government, they have to send your paperwork down a mine shaft in Pennsylvania. That's pretty much how they're clearing checks at the Fed right now, and kind of using that same technology. And that's why when Doge goes into the Fed, I know everybody's, they're going to look at that check clearing operation. It's going to blow their mind about how they've got people walking around with big crates of paper, handing them back and forth to each other like it's 1952 all over again.
Why would they do what they did to the Consumer Protection Bureau? I mean, last time Trump basically put all those people in the basement. Remember, they weren't allowed to have like windows. So they pick on that agency, but the Fed somehow is whistling past the graveyard, in both Trump Part 1 and Trump Part 2. It's crazy with Doge.
Yeah, I think there's two problems with the CPFB. First of all is let's be honest, it's a partisan organization. It was the brainchild of Liz Warren, so right. There was probably a little bit of that going on there. But then the other thing is it's a fairly new organization, and we already have so many overlapping regulatory bodies that we brought in this new organization, and it's like nobody knew what it was supposed to do. Like every time it tried to write a regulation, the FDIC say, that's my job. The Fed say, that's my job. Or the OCC says, that's my job. So it's like, why did we need them in the first place? We've already got an endless number of regulators that do this stuff anyway. We didn't need to pile another one on. So I'm not sorry to see it go, but those are probably the two biggest reasons why they went.
Yeah. Well, I mean, just taking it a step further, which nobody's talking about today, but I think we should just at least quickly speak about it. I mean, what Trump should acknowledge is how many Democrats are at the Fed, both the economists and the people on the board, and the potential for new appointments. Do you foresee or would you anticipate somebody like Judy Shelton finally being approved to be on the Federal Reserve Board? I mean, she's a sound money person, totally different than anything that we've seen, in very recent history, but for a long time at the Fed.
Yeah. So just a quick update. So the Fed board is full with 19 members, and of those 19 members. The way it works is you get to pick one of those 19 to be the chairman, and that would be Powell. So in order for the president to pick a new board member, somebody's got to come off the board. Well, fortunately for Trump, Andrea Kugler's job expires at the end of the year. Her term expires at the end of the year. So he could either reappoint her or reappoint somebody else. So that's the way he gets to replace Jay Powell. And it's almost a certainty he's going to replace Jay Powell with somebody else.
Yeah.
And so, you know, are there too many Democrats on the board? Probably. That's maybe why he took Michelle Bowman off the board, you know, to be the vice chairman and head of supervision.
Yep.
She's probably the most Republican of who's left on the board right now. And, you know, they don't even mince words about it. I thought the Chicago Fed, where I'm from, Chicago, made a egregious mistake in taking Austin Goolsbee as their Fed. I mean, they
Oh.
took a Fox News spokesman for the Democrat Party and made him the Federal Reserve Chairman. Is what I know. He's a PhD in economist from the University of Chicago, so he's got that pedigree. So let's give him that. But he made his chops as a partisan Democrat, and you just put a partisan Democrat right in charge of the Chicago Fed, and I thought that was a big mistake. So yeah, there is a lot of partisanship over at the Fed.
Yeah, there's a little sneaky stuff too with his. Well, I'm not going to get into that. It's not pertinent to the discussion. But the I guess the last question I was going to ask you before we go is, you know, because you've been, you know, equally as critical of Janet Yellen. I mean, to say that Janet Yellen wasn't a partisan hack type biased Federal Reserve Chairman is now plainly evident to anybody who listens to her speak. But I mean, it's, you know, the difference between Scott Bessent, the future for the next, you know, 3-4 years with Bessent, if he lasts that long, versus what you and I have had to endure with the most recent, you know, again, a tacit, I guess, MMT experiment that Yellen, you know, really led.
Yeah. So Bessent and Trump, I'll say this: we're solidly in, and I'm talking to the right person about this, we're solidly into the fourth turning right now.
Yep.
And I think if I was to argue what they're trying to do, and this gets to what Bessent is they're attempting to try and restructure the economy to get us back to the first turning. Now, that's not going to come right away, but eventually we're going to see that. They're starting from a position, and this is what Bessent said last year at the Manhattan Institute. We're one of those rare times in history that comes around once or twice a century that you get like the Treaty of Versailles or the Steel Arrangements or Bretton Woods, where you completely restructure the global order. And we're going to be there, and I want to be part of it. That's exactly what he said, you know, in June of last year. What is that? We've borrowed too much. We've got too much debt. That status quo cannot hold. As a matter of fact, Jay Powell gave a speech in December and said, the fiscal situation is unsustainable and it has to change. So they're changing it. They're changing it in a bunch of ways. It's known as the Mar-a-Lago Accord. The first thing they're doing is they're trying to bring back jobs into the United States in the form of manufacturing jobs and others with the form of tariffs. Now, maybe these tariffs don't work, or maybe they've got an idea that might work, but they're going about it wrong. My complaint with the criticism that everybody has is, so what should they do? They're doing a radical policy, and you are saying it's not a good one. We can't go back to the status quo. We can't just go back to $2 trillion deficits and please raise the debt limit so we can go to $40 trillion of debt. That's not going to work. The bond market would actually have a worse reaction. You're going to have to have weekly 10-year note auctions in that environment, you know, and it would implode even worse if you did that. So if you don't like this radical policy, give me another radical policy that we have to do. And so what they're trying to argue is, we're in the fourth turn. This is unsustainable. We have to try and find a way out of this. Now, it's not going to take a week to get out of this. It might take the rest of his 4-year term to do something like that. But that's what they're trying to do. That's what makes Bessent different from Yellen and everybody else. Everybody else was maintain the status quo, maintain the status quo. He's coming in with Scott Muir, Council of Economic Advisors, and Trump himself, and Bessent, and a lot of other people that think that way, and saying the status quo cannot hold.
Right.
It has to change. If we tried to go backwards to pretend it's 2024 again and just do the same things we were doing, I don't think it would end well. So this is why what we're struggling with, which is why I said earlier it's a step function, that we don't know what's going on because we're trying to do something about it. So I applaud him
Yeah.
I applaud him for recognizing the problem and we have to do it. Maybe we could be critical about the way we're doing the tariff thing. Okay, but then what should we do is really what the question is.
Yeah.
And all of those that criticize him don't really have an answer for that right now. But maybe they should start thinking about it that way.
Well, I mean, in our super short-term clickbait society, talking about Bloomberg headlines to what people are tweeting in the moment, which changes every day, that's just not the plan. The plan is much longer term. Whether you like the plan or not, to your point, Jim, it's the plan, and there's an actual plan by a gentleman in particular that I have respect for. It's not a political comment. He's just, he's one of us. He's same age pretty much. He's been in the business for roughly the same amount of time. He understands markets, and there's a plan. Now, the plan may not work, but there's a plan. And the market hates that plan is not changing as of one tweet by the president yesterday. I mean, as we've been going through our discussion, the S&P has gone from down 4 to down almost 6% on the day. For people that don't know, a down 6% day in the S&P 500 is one of the worst days ever. So again, top 20, I think, all time. So these are the things that people are going to have to deal with: doing longer-term research, understanding longer-term implications, and you did a really good job with that in this conversation. So we're out of time, but thank you for that.
Thank you. Enjoyed the conversation.
He's the man. Jim Bianco. I told you, if I go back to back with Daniel DiMartino Booth and Bianco, and I don't look at my screen other than for a second to look at the spies, that's what we're going to get. And on that topic, up next, we have we're going to have a good conversation between myself and John McNamara and Brendan Ahern.